What's happening, traders? I hope you are well. In this video, we are going to discuss how I deal with limit orders and spreads. Now, this is part of a series of videos that is entirely being fueled by your comments. And I have to say again, I really do appreciate your support, you guys sticking around, commenting, keeping me updated with what's going on, your frustrations, your pain points. And I'm hoping that somewhere along the line that one of these videos will really open your eyes and hopefully give you the insight that you need so you can take your trading to another level. I am still learning. I am still growing. I am by no means an expert. But, this is all still kind of new territory for me in a sense that, every single day I'm taking a different perspective of the market and taking in how I feel about the market and how I acknowledge the market and how I feel about myself in relation to the market, and how I'm feeling about myself plays a massive part on how I interact with the market on a daily basis. It kind of goes a hell of a lot deeper than just looking at charts and basing your execution points of technical analysis and, all that type of stuff. But today, we're going to discuss limit orders and spreads. Let me give you some highlights of what the next videos are going to be about. Also, we're going to be discussing how to identify quality zones. We're also going to be discussing how I qualify engulfing candles, how I prepare for the week, and the challenges of multiple layers of supply and demand. So let's get into this video, which is how I kind of deal with limit orders and spreads. So here we are on the Euro USD, where I actually have a trade on. If we look to the left, way over here, let me just grab this, it's a bit easier that way. Okay, didn't even zoom in, no problem. So we can see that this over here, we have my picture over here, that engulfing candle. Love you, baby. As you can see, the market came out, dropped in, more orders filled, dropped back in, more orders filled, and then boom, went on a glorious run. Now let's go over here. You can see the market has now dropped in to this daily zone, which would be event 1. So let's just go down to the H1 chart. And let's see what's going on here. So, got this right here. Alright, so we can see where event 2 has been broken, which leads us to event 3. Now, you can see that my entry point is way up here, right? There's 2 options. I decided to play it up here, reason being that I've had a lot of screen time and screen awareness, and I've seen this happen multiple times before. Okay, so, that's just how I played this trade. Normally, let me just make this green. I would have placed it down here at the engulfing, right? Now, the reason why I'm not taking this all the way to the end of this wick is because, number one, I don't want to risk all of those points. So I just took it down to this level here. As we can see over here, where it's just basically getting kind of like resistance around this level here, and this fakie. So I didn't want to pull in that whole wick. So I just took it here, and I think that was around 20 points. Let's just take a quick look. Oh no, sorry. Let me take this up to here. And if we grab this again, yeah, 19 points. Okay. All right. So now we want to look at spreads and limit orders. So number one, limit order. Simply place my limit order just on this line or above this line, depending on the spread. Right now, let's say, for instance, the Euro USD has a spread of 0.7. So as you can see, my entry is probably just like a pip above here right now. So if this is 1143, then my entry is going to be at 1144. Okay, because the last thing that you want is the market coming down, hitting your number on the dot, and then bouncing away because you didn't factor in the spread. So let's say, for instance, that, there's plenty of markets out there that have like a 3, like for instance, crude, I think, has a 2.5 or a 3 pip spread. Let's say there's a 5 pip spread, right? And let me just get a draw tool out. So let's say if you want to do a 5 pip spread, so you have to factor that in. So maybe your 5 pip spread is, let's say it's up here, for instance. Right? So your entry is going to be here because you're factoring this 5 pips. So when the market hits this, your entry is going to enter here. But then you also have to factor this in for the stop loss as well. Because what can also happen, hold on, that's the wrong one. Let me just get this there. Okay, perfect. So let's say, for instance, the market goes really deep into this level and you've got your stop here, right? It's going to take you 5 pips out up here, but it's not even going to come down to your stop before it takes it out. It's going to cut to about here. The market's going to factor in that 5 pips, and it's going to take you out without the market actually even reaching down to this level here. So when you do have like a 5, 6, or 7 pip spread, depending on what product you're trading, it's also wise to bring down your cost per point. So if you're doing like, £10 per point, you may want to bring that down to like, 6 or 7. If you're doing like £5 to £7 per point, you may want to bring that down to like 2 to 4, depending on your risk tolerance, right? So when it comes to factoring spreads within your limit orders, you just have to be aware of that, because there's no point having your entry here on a 5 pip spread, but the market will just come here, touch it, and then bounce, because the 5 pips where it needed to get to was somewhere in here, right? So it's just so important to make sure that you factor in that spread with all of your trades. And the markets that I trade, the maximum spread on them, I think, is crude, which is like 2.5 or 3, depending on the time that it's traded, but mainly 2.5 pips. Yes, there are some exotics like, Japan 225, which has like a 7 pip spread in the evening and like a 15 pip spread during the day, which is insane, but it's a crazy product to trade and people can make a ton of money off that. That thing moves like hundreds of points a day. But just remember that if you're factoring the spread at your trigger point, you also have to factor in the spread for your stop loss. Okay, just remember that. And when I was talking about engulfing candles, we can see that. Okay, so let me just give you some information as well on what happened on this trade so far, just to make you aware. So when the market hit this area here, this base drop, I took off 50% of this trade, and then the market came back down. I decided to just leave it. I was like, okay, cool. Market came back down, and look where it hit. The engulfing candle on the nose and then popped again. All right. And if we take a look at what that risk would have been, we're looking at 13 pips. All right. It's awesome. These engulfing candles are amazing in the right context. Okay. Not every engulfing candle gives you the right or the permission to put a zone around it and then wait for the market to come into that zone, right? The engulfing candle within the right context really delivers. And we'll go into that in the video where how I qualify engulfing candles. So that is it for today, traders. I hope that is clear when it comes to limit orders and spreads. And again, as I said, this is part of a series of videos where where all of these videos are going to be fueled by your comments